So today I'm going to talk about the JFK-era benefit. People say, what are you talking about? This is going back to 1960, 63. Well, you know, there was and is a benefit that went all the way back to 1960, maybe 1957. I couldn't track it. It was the JFK-era benefit. And business owners made themselves extremely wealthy using this benefit, and they still do today. And we're going to talk about this benefit because many advisors are not even aware of it, because it's been used by very large companies and the Fortune 500, these type of companies to compensate their executives, the high-level people. But over the years, the law and the product changed enough to design it for the smaller market, which is what I work with, the business owner market. So we're going to talk about Leo. He's a client of mine who actually could use the JFK-era benefit that I'm going to talk about today because of this situation. So let me give you a little background. Leo was and is a client with a great business, makes good money, been successful. He has a 401k, but he found out he was very limited to put money in. And when we did the projection and he found out he was only going to have 40% of his final pay, and his rank and file people were going to have 65 to 85% because they have Social Security and they have a lower income. Well, that didn't sit well with Leo. He didn't like that whole deal, but he couldn't change his pension plan, nor did he want to. So we introduced to him when he came to us and say, Tom, what do you think we should do? He was thinking about putting money away in an investment, getting taxed on it before it came out of the company. And I suggested to him to put in a SEEP, a corporate equity executive plan, which is a program going back to the 1950s and the JFK era, and the era where businessmen were able to put tons of money away and retire with a lot of money. Well, we did. We took a look at it, and what was really nice about it is that Leo realized that he could take a deduction at some point with it, and he called that shot. It was financial friendly to his spreadsheet and his financial papers. He could use the asset before 59 and a half. Wow. I said to him, listen, Leo, you could actually use this money, take it out tax-free to buy your inventory, turn your inventory, make your profit, put it back. How good is that? You don't even get a banker involved. He could elect the people he wants to be in it, or none. He told me that he was going to and planning on putting his kids on the plan for their retirement because he could. He could elect also what he wants to put in, and there's nobody saying to him, you are limited, you can only put this much, you have to add these people. So there's so much more to it that he realized once he got into it. And what he really liked the most about it was that, you know what, I'm going to put it in $1. And I don't have to share that because I do so much for my employees now. There's nothing they want for. We have good health benefits. They get time off. I give them raises. But for this one, this is special for me and my family. He can control the contributions. He could put in what he wants, when he wants. He can skip, add, change it. He can, as I said, use the money before 59 and a half. I talked about the inventory use. It's totally funded by his company, and the amount of the imputed tax he's got to pay is so small. On $50,000 a year, we figured out that he's going to pay the taxes on about $2,000. So the company's going to put in 50 grand into the plan. He's going to end up paying somewhere in the area of $800 in taxes. That's it. And again, like I said, he can control the deduction. At his death, what's nice, there's a couple things at his death. If he dies, the plan will complete what he was planning on accumulating tax-free. So if he put in 50 and he figured he'd have $1 million there, at his death from day one, that afternoon, his family gets $1 million tax-free. And guess what? No one's forcing them to take the money out. They could use it anyways. There's nothing like an RMD or required minimum distribution. So there's no force out. And like I said, and there's no inheritance force out like a 401k. So like a 401k, an IRA or profit sharing, you leave it to your family, whether it be your spouse or your children. There's a force out. They have to start taking the money out, and it's 100% taxable to them. In the SEEP plan, that does not exist. It's tax-free, and the family can do what they want with it, use it or not use it the way they want. So we really did very well with Leo, but Leo is one of many people that own a company that are in the same situation. So my advice to you as a business owner is take a look at and get a projection on where your 401k, profit sharing plan, IRA, wherever it's going to be in relationship to your salary and future Social Security. You might find that a SEEP might fit in pretty nice in your cash flow plans, or if you just want to put more money away for legacy. But listen, if you wish to talk to me about it, please email me, tperrone@necgginc.com, or call me 203-530-6615. Always willing to talk to you. I'm Tom Perrone, and I hope this was valuable. Thank you.